Ron from Rohde Law, and in this video we're going to talk about who buys multifamily. Very simple, the best type of investor for multifamily. Watch this video to find out more. Ron from Rohde Law, and we represent a variety of investors only dealing in investment commercial real estate, and we close tons. I'm talking hundreds of millions of multifamily transactions, and I've really kind of identified two main types of buyers for multifamily. And in this video, we're going to talk about multifamily in today's climate and see if it's a right fit for you as you proceed on your investment journey. All right. So the first investor is somebody who already has money. And what I mean by that is they've been investing or they've been working for a long time, 10, 20, 30 years of experience, and they've accumulated a significant amount of investable assets. And they've chosen whether to pull it out of the stock market or they're just reallocating some of their portfolio. But these are people who are mainly looking to preserve existing wealth while growing at a steady, risk-free rate. So I put people in this camp, right? These are a lot of 1031 buyers. These are people with large windfalls or lump sums from a lifetime of investment. But their primary goal is capital preservation with inflation beating returns. And that's it. It's a very simple, they tend to just be a small group of individuals, maybe single owner, but that's the first camp. And they love multifamily, right? I have a great quote from a mentor of mine, Ted Good, you should look him up. But he said, you will never lose money with apartments and lose money in multifamily. And the reason for that is everybody needs a roof over their head. There's always demand, up and down the vertical stack. The only question is, at what rent do you remain full? And what I mean by that is you have a building, you pro forma it out, $2,000 a month average per rent. Okay, fine, I get it. It's a $1.20 a foot. If there's a recession and things go crazy, your occupancy drops. You just need to reduce your rent, because when you reduce your rent to $1,800 to $1,500, you're gonna find more occupants. And again, that's assuming a lot of things, that it's a well-run building, it's clean, it's safe, it's modern. I get all that, but you will always be able to find tenants. It only just depends on the price. And so in that regard, you can always cover cash flow, you can always cover your debts. It's really important in terms of risk assessments that I can always cover my expenses, but you'll never lose money. You might not make money in terms of profit, but you'll never lose money in multifamily if you price it right. So that's the first camp. And again, I think these people, they're buying large buildings. They're not utilizing investment capital. They're not using LPs. It's really just their own money, maybe 1031ing over a lifetime. A lifetime of 1031s really kind of grows tax-free to a very large equity piece. And that's the first camp. If you're not part of that camp, that's okay. The second choice is for you. The second group of investors is people that want to grow their money. And these are people that are looking to build wealth through multifamily. They are typically going to be looking for more aggressive value add. They're not going to want to purchase kind of at the top of the market for stabilized product. They want to do something, right? They want to use their own equity, their own time to implement a value add plan. They want to do X and raise rents. They're not really relying on passive appreciation, forced cap rate compression, or interest rates to vary. They really want to buy, maybe using other people's money, right? These are a lot of syndicators out there, but you don't need to be. Watch some of my other videos on just how to joint venture. That is really the easiest stepping stone. If you run out of your own money, just partner with 2 or 3 people to put your own capital directly into the SPE, buy the dirt, be active members, don't need to raise money. It's a very simple way to step into the next level. And a lot of people don't know, there's a medium level between your own money and raising Reg D syndicated funds. And that middle level is joint venture, okay? For that type of investor, they really want to get in, they want to implement the plan, raise rents, look for the right buyer, and then exit. Oftentimes, within 2 or 3 years. They don't have a long-term hold period. And so that really depends on, what your goals are as an investor. But what I will say, multifamily is right for a lot of people. Whatever your goals are, there is a multifamily property, there's a multifamily location, there's portfolio, there is a scale. All of your needs can be met by multifamily if you're interested in building wealth through real estate. It is by far the most liquid type of commercial real estate. It has plenty of buyers at all levels, from unsophisticated mom and pops all the way to institutional level. Everybody is buying multifamily, and if you price it right, you'll always be able to find a buyer. It's one of the most competitive, I would say, for vendors. Everybody wants to do that type of work, from GCs to contractors, landscapers, property management. I mean, you can't throw a stick without hitting 15 different property managers for multifamily properties. That said, there is a lot of competition, and in the last 4 to 5 years, it has been incredible competition with a lot of people with a lot of money trying to bid on a ton of properties. But now in this economic climate, right? I'm doing this video in 2022. Interest rates are through the roof. We're talking about recession. The labor market is still pretty strong, but who knows what's going to happen with Ukraine, the Middle East, all this. In this period of uncertainty, there are fewer buyers. Now, you need to understand that you're going to take some risk moving against the herd, but this is your advantage. And so I would say to be a multifamily buyer now, it's not as strong of a risk, but when the tide is washing out, this is where you make your most money, right? There's a lot of investors that made a ton of money. I'm looking at like Sam Zell. The guy's a genius, very smart. You buy distress. You buy when other people are not buying, and that's how you make your money. They're not making their money, and they're not building hundreds of millions of profit, making tiny little half a percentage profit, buying when times are good and selling when times are good. That's great. You're paying a high price, you're selling at a slightly higher price. But if you can buy now when people are afraid, I think that a distressed debt fund is really good right now. A distressed equity fund, where a lot of these IO lenders, people were buying on 24, 18-month IO. If their note is coming due in the next 6 months and interest rates are sitting at 6.5%, they will not be able to refinance if they don't drastically improve their NOI. And again, supply chain delays, labor shortages, very easily they could not have completed their renovation schedule. And so therefore their net income is not where it needs to be in order to hit a higher valuation at a higher cap rate and paying a higher fixed debt rate. These people are going to be in trouble, right? And I don't want to say that they're truly distressed, but they don't have a lot of options. And so an opportunistic investor who understands the financial pressure that they're on will be able to come in opportunistically, lend them some equity, give them a cushion so they can put perm debt, and then you'll be ready to step in if they default again. And they miss their equity. You can wipe out all that junior equity and take control of the asset with kind of a recapitalized capital structure. So that's my tip for who buys multifamily right now. It is still an opportunity, but you must be firm. You must know that the underlying asset hasn't changed. The only thing that has changed is external factors that makes less competition for you. Thanks for watching Who Buys Multifamily. Smash that like button, subscribe if you like the content, and we'll see you next time.